Indian markets continued their downward spiral for the fourth straight week, weighed down by weak Q2 earnings and steady foreign outflows. Now, this past week, Nifty shed nearly 3%, closing at its lowest point in 2.5 months. Meanwhile, the Sensex dropped almost 2,400 points, falling below the 80,000 mark for the first time since August 14th. Both Nifty and Sensex have now fallen almost 8% from their record high levels. And if you think that's bad, the broader markets took an even bigger hit. The mid and small cap indices are now at their lowest levels in 4 months, each down by 9% from their recent peaks. So the question is the worst behind us, or should we brace for further selling in the days ahead? What are the factors investors need to keep an eye out on? To discuss this and more, we are joined by Mohit Gang, co-founder and CEO of Moneyfront. Mohit, thanks for giving us time here on News9. Now, the stock market is on a 4-week losing streak. What are the main factors that are driving the market slower?
Thank you, Suyash. Look, honestly, I think this has come out as a different kind of a Diwali gift to everyone. Honestly, I think people were wanting some healthy correction, but to my mind, this is more than healthy when it happens on one's portfolio. Then one realizes that okay, wishing for a healthy correction is not always a great thing in markets and in life. I think there are multiple factors to it. One prime reason seems to be that the earnings season is not going as per expectations. Honestly, I think market was heavily loaded on very huge expectations, which even if there is a minute disappointment, is getting punished brutally by the market. I think for the year put together, the EPS growth on Nifty is not looking extremely attractive. We might have a single digit EPS growth for this financial year on the back of 2 consecutive years of double digit growth, or in fact, high double digit growth. Right. So my sense is I think market is not taking very kindly to all of those things. Club with that, the geopolitical situation is such that market is always on tenterhooks that what will be the next step on the geopolitical scene, right? So Israel-Iran situation hasn't de-escalated even a single bit. In fact, the entire world is waiting with bated breath as to what the next step from Israel will be. And then you hear news of Turkey kind of doing some airstrikes on Syria and Israel and other things happening around the world, right? So the geopolitical situation is not de-escalating; it's only getting severe by the day as we are talking. Third reason, perhaps, is that a lot of FII outflow. Honestly, I think a lot has been spoken about the same in media. 90,000 crores of FII outflow in a single month is massive, Swish. It is massive. Hats off to DIIs and hats off to the retail investors of this country who have actually held on to the market to such a large extent. Otherwise, we would have crumbled like anything if it were not for that kind of a support in the market. Look, and again, the reasons could be multifold. It could be basically investors fleeing to attractive markets like China or Hong Kong, or perhaps investors moving back to the safety net of US dollars, or maybe because of US elections, a lot of money going back to US for some time, that till such time that there is uncertainty out there. Right. So there could be multiple reasons for it. One cannot exactly pinpoint what the right reason for that is. But yes, FI outflow is a reality which is hitting us hard. If you compare with what FIIs hold in the complete market of India, it's very small, honestly, compared to what the actual holding is. But then still, 80,000 crores is not a small amount by any means. Right. And then you have certain big IPOs which have come, which have drained out certain amount of liquidity from the market. So everything. Look, it's multiple reasons. Very difficult always in a falling market to pinpoint what exactly is the major reason which is leading to it. One clubs with another, and then the whole situation kind of unfolds. So my sense is yes, I think everything has come together. When it rains, it pours, and that's what is happening right now. So yeah, I think all of these factors put together is a big reason.
The question on everyone's mind now, Mohit, is that will this correction continue, or do you think that the worst is behind us?
Very difficult to call out, Suyesh. Honestly, I think it's an extremely tricky scenario because market will always overdo on one extreme. Even while going up, it overstretched itself, and even in a falling market, I think it is kind of overstretching itself. Valuation wise, there are pockets which you can still call expensive, but I think on a broader sense, the mid and small caps to a very large extent, the froth has been cleaned off from the market. Uh, I can't honestly say the worst case scenario for me to be would honestly be another 200 odd points on Nifty, maybe perhaps, and not beyond that. But I could be dramatically wrong and dramatically off on this one. right? It doesn't look like though that we are climbing back in a hurry. And I would want to caution that out because honestly, the season ahead is looking a little challenging. It's not just the EPS growth on Nifty or the corporate earnings, it's also the other data around which is not looking very healthy. Inflation is again inching up. Food inflation is fairly high. IIP is gone negative. Right, your GST collections are fairly low. And the festive season has already started. Honestly, the festive season, the green shoot should have been visible, but which is not so evident, honestly. Right. So my sense is it's a wait and watch scenario for some time. For people who are sitting on cash, yes, they can start dipping in gradually. With a 2 year view, it's not a bad level. With a 1 year view, it's still a decent level. With a 3 month call, I'm not sure. So that's the whole outlook. And for those who are not sitting on cash, you can't do much out here. I don't think so. It's a great idea to kind of encash out now from the market.
So, just to be clear, you don't expect quick recovery from here on, because in the past 12 to 15 months, we have seen that, there would have been intermittent corrections, but the recovery was equally sharp. Do you think that this time around the setup is much different, one that perhaps doesn't warrant swift recovery?
For any recovery, you need support of some good news, and good news then has to flow from 2 3 corridors. My sense is the only foreseeable good news which I see around right now, which could be a good trigger point from a market's perspective, is the RBI cutting of rates, right? And that can happen in November. And US election potentially, though I don't know how does the market reacts to one side over the other. It's a very difficult call, honestly. But I think the second trigger could be US election. So that kind of the entire thing unfolds itself in November second week. So my sense is till then it's a very difficult call to take. But these two could be potential triggers for the market to actually rewind back. Will it be like a full J-curve kind of a scenario? I honestly doubt that. It could be a little more sideways and then a gradual uphill climb. That's what actually looks like to me.
All right. And speaking of RBI and what it does next, do you think that there is a chance of a rate cut come December? Because Governor Shaktikanta Das, he recently shot down the call for rate cuts, but at the same time, we are also witnessing a slowdown in both rural as well as urban consumption, as indicated in the Q2 results of FMCG players. So, do you think that there would be a strong case for a rate cut by the time December rolls around?
Look, honestly, I think if Fed goes aggressive again in November, then my sense is yes, RBI will have enough and more headroom to go with a 25 bips rate cut. If Fed kind of holds or does a small cut or a token cut, then yes, RBI can perhaps hold for another quarter or so. India need not be in such a rush to cut the rates. Honestly, I think inflation is heading back up, inching back up, and we discussed it just a couple of minutes back. And food inflation is a cause of worry, but I'm not sure how much can monetary policy really help on the food inflation side. So I'm not really honestly gung ho about a monetary policy being very effective, highly effective on controlling food inflation. So that's more related to other factors in the economy. But yes, RBI might still want to hold the rates if the inflation doesn't come below its this thing. But yes, consumption is hitting, it's hurting. The private capex cycle, I think, Suyesh, is also one positive thing which might just about be kicking off in India. And I think if interest rates cuts starts happening, that rate can get accelerated and perhaps will lead to good recovery in next couple of years in the market. So it's a slightly more longish cycle to track. But I think that could be a good signal for revival and perhaps can yield you great results in the market from next financial year onwards.
Sure, but on the other side, Mohit, RBI is also concerned about decline in bank deposits, which could further exacerbate with a rate cut with FD rates going down and all. What's your opinion on that?
Which is true. Look, so FD rates haven't kind of inched up this time around in this cycle to what do you say, the higher levels which we have seen in previous cycles. And my sense is from here on we've already peaked out. FD rates will only inch lower, whether now or maybe in 6 months of time, right? So that is a clear writing on the wall. And the story of Indians moving away from bank deposits and moving away into financial instruments or not saving enough and consuming more, I think that's a story across the globe. So it's not just an Indian story, but yes, Indians are now catching up to that story after a fair while, right? The US has always been that kind of a story, and perhaps few other European nations also. So India is just catching up to that trend, and my sense is India will go a long way on that trend. Honestly, I think we will see further depletion in savings rate and further move into consumption as Indians travel more, as Indians spend more, as they get more accustomed to luxurious items and everything. I think this is one trend which is here to stay for a long, long while. And I think banks and will have to align accordingly.
All right, this year discussions about a potential black swan event have resurfaced repeatedly. Now, with the US presidential elections just days away, a significant global event, opinion polls suggest a tight race between Kamala Harris and Donald Trump. Now, given the latest polling trends, in which scenario would you likely see a sharper market correction? A Trump win or a Harris win? Or is there a chance that the market may not react significantly at all?
It's a race to the wire, honestly. I think it's a thing which will go down to the wire. Seems very close to call out unless something dramatic happens and right, it just completely flips in one on the one side, but it doesn't look likely to happen that ways. My sense is a Trump victory is more favored by the markets because he's considered more pro capitalism, pro industrialism. He's himself been a industrialist and everything, but I'm not an expert on these things, and I'm honestly not too keen to call this one out. Even if Harris wins, honestly, I think one way of looking at it will the policy continuation is there. You don't see dramatic change or shift of stance with a major shift in the government, right? So that could be one way of looking at it. But yeah, from a market's perspective, from whatever I talk to the experts and the veterans or whatever I hear the chatter around, it seems like a Trump victory might be more favored by the market. But again, as I said, it's a very close call, honestly, and it'll go down the wire.
So Mohit, if Trump returns to power, do you think that it would create an even more polarized geo-economic environment? Because he has been vocal about imposing massive tariffs on countries that are shifting away from the dollar, even as the world is seeking alternatives and the dollar's share in global trade continues to decline.
That is any which way is happening, Suresh. Even if a Trump comes or Harris, I think that's a trend which is here to stay. It's a moment whose time has come. Honestly, if you see the BRICS summit which happened just a couple of days back, I think there is all the chatter around starting a new currency or starting a new what do you say mechanism for trade between India, China, Russia. Because any which ways these countries, in fact, China, Russia, and China are feeling more and more alienated because of US sanctions per se for Russia and US restrictions on the trade mechanisms going on with China, right? So they are any which ways trying and figuring out the percentage share of US dollar is already reduced to almost 51 odd percent in global reserve share, currency reserve share, right? But yuan has a long way to go. Yuan has a long way to go. So honestly, intuitively, it looks like that yuan is the second best solution to a de-dollarized world, but it has a long way to catch. My sense is they're not more than 2 to 4% of the world's reserve currency status. So it's a long way for yuan to catch, but these are big order cycles. These don't change so dramatically. These will take years and years to unfold. Finally, my sense is every currency lives for around 150 odd years. It typically crosses three generations, and US has already lived for two generations, almost two and a half. So my sense is they have still some headway unless something dramatic happens. US reduces its debt or devalues its currency dramatically. To kind of salvage the scenario, because the kind of debt they are piling up is honestly unsustainable to a very large extent, and something will break through in the globe. Not right now, not in immediate future, but yes, perhaps in times to come, something has to change the world.